let's talk a bit about your experience in raising funding, because I can remember back when I was in my initial days of DGM, I was looking at different options and whatever it is, how to push through the weeds. And one conversation we had where you gave me, having experience with, fundraising and whatever it is, it was an option I was maybe considering, if you need to survive, how do you do that? Although I never, ever got the funding, I didn't, follow the advice you gave me, not because I thought it was invaluable, but I managed to pull through organically.
Nice.
But I think your advice was great. And let's talk about, how does a startup get funding? What are the things that founders of a business need to look at? What are the important things, and how do you get funding? And have discussed this in one of my previous podcasts where it was a crowdfunding, right?
Yes.
So I had an individual who's involved with crowdfunding,
yes.
like Indiegogo or these, which is crowd-based funding. It's different. Getting funding from angel investors is a whole other ball game, right? And what was said back then, and just my kind of feedback, I'll say it now. It's one thing to get funding, but it's another thing to actually build a successful business and execute, right? So we don't need to talk about the successes of building or you could, why not talk about how do you build a successful business? But I think before that, talk about your experience around how to get funding.
Yes. So just to provide the context, my experience from fundraising and funding comes from, the several ventures that I have founded. I have raised in total, if you add up, approximately $20 million in, equity financing. And now as well, what I have a very unique experience is that I'm also a venture partner at a VC. So I also now understand very much the process on the other side, because when you fundraise as a founder, which I did quite successfully, you kind of never understand what's happening on the other side. And I think what could be useful for a lot of people is for a founder who is now also part of a VC to explain the story, what's actually happening, and maybe to explain why you many times got the funding or didn't get the funding, if we're kind of talking about that. And first, I want to really mention something that you emphasize very important is it's a founder decision. Do you want to raise external capital or not? And this should be both your personal decision, how you want to build your business, but the second one, are you a fundable company? I think this is also a very important story. When it comes to personal decision, I want to emphasize that you should really here reflect as a founder is, do you think that it's the best possible path for you and your company to have sizable external shareholders who have a big impact and control over your company? Because as soon as you have a lot of external capital, you're not the person in charge anymore. And especially if you have less than 50% of shares, you are not the person in charge actually. You are their shareholder, you're a CEO or a C-level team member, but you don't own the company in that sense actually. So it's first very big reflection, do you want to give up that power? And I think today you emphasize something very important. I think the trend going forward is going to be bootstrapping. Because today with AI technologies, with blockchain technologies, and with the ease of setting up and kickstarting a business, which went down a lot lower, for many founders, raising external capital is not needed anymore, or will be a lot less needed for specific type of businesses. But after you reflect on it and I say, I want to be a fundable, I want to raise capital from professional institutional investors and VCs, you really have to understand is that VCs, the way that their business model works is they usually invest in 100 companies and a few companies make it big and all other fail. They go to zero. Now, if you think of that, you think how can this business model work? And I'll explain how it works. You invest into 100 companies, 3 give you 1,000x. So if you invested 1 million, as an example, for instance, 3 of them give you 1,000x. So on these ones, you make 3 billion in total. And the fact that all the other ones went to zero or completely irrelevant, that doesn't move the needle for you from a perspective of that you have to return capital and profits to your investor, because as a VC, you have an investor. So this is how the business model works. So when a VC invests, they very much look at, can this investment opportunity give me a sizable, really, really huge return? So they don't care if you return them 20% after 5 years. It's not important. Can you give them 20x, 50x, 100x? That's the business model. So when they look at you, they will look at your business and say, can we close our eyes and imagine the market that you operate becoming so big and you becoming such a big relevant player that we can get that return?
Thank you for watching. If you liked that video and you want to watch the full episode, it's available here. Remember to like, subscribe and share. It helps the channel.